All right, everybody, welcome back for another episode of the Entrepreneur Aligned podcast. I'm your host, as always, Jarrod Musick. Today, we're talking about the role of investment planning as it relates to financial planning and what the sequence looks like there specifically for entrepreneurs. So, I think one of the questions that we get asked frequently is, what should I do with my money, right? What should I invest in? And that really jumps way ahead in the process, right? So the purpose of investing is unique to everybody, but in general, what you're investing for is two things. One, protecting against inflation. We know that there's inflation at work. The value of the dollar declines over time. It ebbs and flows at various rates based on fiscal policy, monetary policy, whatever's happening. But we know that our dollar today is worth less than it was 5 years ago, certainly less than it was 50 years ago, et cetera, et cetera. So holding money in cash, you can take out that volatility risk, meaning your absolute value is not going to go up or down, 10, 20, 30% on a given day, but it will be eaten away by inflation by a couple of percent every year. So you can't just hold your money in cash. You need to do something else with it that protects against inflation. And then, so that's number one, is protect against inflation. Item number two is you want to grow capital so that you have more to work with in the future, right? That's pretty simple, pretty standard. You could put it in certificates of deposit. Now you're hopefully going to get inflation plus an extra little bit. And you can do things all the way out to keeping the money inside your business, which is probably where it's going to grow the fastest. So if we're looking at those being the two variables and the two things that govern what we're investing for, that really sets the tone. So number one, we're protecting ourselves against inflation. And number two, we're growing our capital so that we have more to work with in the future. I think for those of us who own businesses, employ people, really have to show up and generate and create wealth for ourselves, our families, and others that are inside and outside of our company, it's pretty second nature that we got to do better with what we've been given. That is just an urge, right? I've got to turn this into something more than what I started with. I have to be a good steward of these assets. I have to continue to grow them for the future. So now we've governed what we're trying to do, which is protect against inflation and grow capital. So now, how do we actually go about the process? Notice I'm still talking process. We're not into let me select assets. How do I evaluate one asset or opportunity versus another? We really need to go back to it is still financial planning first, not investment management. So financial planning is a process that helps us uncover what we need, when we need it, and how sure we are that we are actually right about those things, right? So what's the probability that we're accurate in what we think? We might want to buy a vacation home in 3 years, right? It could be 2, it could be 5, but planning allows us to say, okay, best guess, we're going to want this vacation home. It's going to be $3 million, and we want it in 3 years with cash. That's a pretty good starting point to understand, okay, what does our need set look like? And then how confident are we? So that's number one, is when do you think you're going to need your money? How much? All of those variables about when does your money need to show up. So now looking at the money you already have available today, you're doing an assessment of what do I have? Where is it? So you're looking at things like liquidity, meaning if you have it all in a very difficult to sell piece of private real estate, it's not very liquid. It could be very valuable. It could be returning great. You don't know, but you do know that it's probably more difficult to sell than if you have it in a money market fund inside your brokerage account. So really making a thorough map of where all of your assets are today. And you want to look at where that number is heading in terms of spending and saving. Now, this part gets really, really tricky for those of us that own businesses because our cash flows can be lumpy, they can be seasonal, they can be highly connected to the economic environment, they can have certain factors that affect our industry and no other, right? So really being able to forecast with a wider range of accuracy assumptions, right? How right are you that you're going to be able to take $1 million out of your business this year? Maybe it's $500,000, maybe it's 1.5. That's a lot wider range than a lot of your peers who have jobs and they may have bonuses or commissions or different things that will help dictate their compensation, but they know if they have a $150,000 base, is their bonus going to be zero or is it going to be 25,000? That's probably the range they're planning for. So really looking at, what do I have coming in terms of income? What do I have going out in terms of expenses? That's really what we're looking at in terms of, is that number going up or is it coming down? And then you also want to look at cushion, right? So if you have a business that could go to zero on revenue, it's non-recurring revenue or a smaller percentage of it is recurring. Um, we talk to business owners who, Google or Meta make a change in terms of their algorithm and how you rank. Well, if you have a company that's highly dependent on digital advertising, you can see an immediate fall off in your revenue just because Google or Meta decided to update how they actually process and display ads to your target market. So if you're looking at, we have a high probability that our cash flow could fluctuate significantly down in the near term, you need more cash reserves, you need more cushion. If you have, a recurring revenue business model that's very, very stable, long-term multi-year contracts, et cetera, you may not need as much cushion or as much in capital reserves in the business and personally. But again, that's something that you need to plan for. So I've just spent the last 6 minutes talking about things that are not investing, but are necessary to get us to the point where we're ready to start thinking about investing. So now that we have clarity on why we're investing, protect against inflation, grow capital so we have more to work with in the future. We've done a little bit of personal financial planning. We know what's coming in, what's going out, how sure we are that those things are going to happen, what needs, large needs we think we're going to have in the future and when those will show up, and how much cushion or capital reserve we need business and personally. Now you're actually ready to start looking at, okay, what do we want to build in an investment portfolio? So I'm a big fan of making sure that each account has a purpose, right? So if you have a checking and savings account, that's cash account, that's operating cash, that's liquid reserves that you're planning on. I'm going to lose a little bit of ground to inflation with the money in this account, but I am very, very certain that it's going to be there if and when I need it in the future. Brokerage accounts tend to be growth accounts. Now, maybe you're going to split those out. We do this with a lot of our clients where they may have like a revocable living trust, and we will do same tax type but different accounts. So they may tie back to the Johnny and Janie Brown, revocable living trust, but we have the Johnny and Janie Brown number one, number two, and number three. Number one might be cash and cash equivalents, so it's invested in premium money market. As I'm recording this, those are returning about 5.25%. So definitely better than inflation. So that might be their, beyond operating, beyond their checking and savings account, cash reserve. Number two might be targeted to a specific need. So that vacation house that I talked about, the $3 million, right? That number two might be growing for 3 years. It's intended to be a growth focused account for the first 2 years and a cash equivalent account for the third year so that it's there when they're ready to purchase their $3 million vacation home. And number three may be, longer term capital growth, right? That may be a way to slice up a brokerage account. But again, notice I'm giving each of those accounts or sub accounts a different purpose. You can also do the same thing with accounts for tax reserves, business backup, college funds. Retirement accounts are a very, very classic one that we've all been conditioned to understand really well that, hey, this is not for me, this is for future me, whether it's your 401k or a SEP or something else. Retirement accounts are a good way to mentally and emotionally tag that. We also see this with a lot of our client families that individual real estate properties may be tagged for a specific purpose. So we may have somebody who has bought a commercial building when their children are young and said, great, this is how we're going to fund their higher education. And then we will go ahead and liquidate it when they're done with higher education and give them each the proceeds to go buy a home. I've seen that a couple of times. That's a really cool idea. You can also tag them to other things, for your business, right? So if you have an owner-occupied commercial property and you're saying, great, the business itself is going to have this specific purpose. And then when we exit, the real estate property that goes along with that business, which is held in a separate entity, is going to have a different purpose, right? So again, that could be a great thing for a vacation home or seed money for the next venture. Maybe something that your spouse wants to do once you've kind of had your time in the driver's seat with your company. Maybe they want to go start their own. Next, we have private investments. So this is really, real estate is certainly private, but now we're talking about some other interesting things, right? So you've got private venture capital, private equity, different types of syndicated deals that you may be looking at doing. Make sure that those map back to your overall investment philosophy, what you're trying to do, and that they have a purpose. Where we see a lot of people get into trouble is drift, that they go, well, I know that we said I want to keep, these dollars highly liquid because I have $20 million of illiquid equity inside my business. And we agreed to that, but this opportunity just came up. My buddy gave me this, pitch deck, and it looks amazing, and I'd really love to be able to invest in it. I'm not saying that's a bad idea, but if you do that and you do that over and over and over, you've drifted away from what you were trying to do. The purpose of those dollars may not be the same as what you originally intended. So try to not get fixated on the shiny objects that come up. That's one of the things being a business owner. You get pitched a lot of great ideas from other business owners, people who are raising capital for different projects. It's fantastic. It is truly an honor to have the opportunity to review those, but make sure that you're disciplined as you do. And if you take those opportunities, make sure they fit with your overall strategy. The last piece here is business equity. So in your primary business, you need to treat that equity just like any other investment that you have. So business equity should have a picture of when it's going to be realized. You should understand the cash flows that you're expecting to generate out of it. You should understand the risk profile that you have in there and continue to review that like an investment, which can be really difficult to do when you're operating day to day inside that company and saying, man, I'm just focused on the next step, the next thing, generate revenue, up level our service, find the next key team member, and on and on and on. But you want to make sure that you're still taking those opportunities to pull back every quarter, every year, and look at it like the investment that it actually is. So those are some of the main areas, and mapping them to a purpose is a really important piece. One of the other concepts that we always work with our clients on is there's a difference between risk tolerance, which is how much can you mentally, emotionally take, how much volatility can you endure, which if you're an entrepreneur is probably pretty high, right? How much are you willing to see your investments go down in value before you tap out and say, I've got to sell, I've got to figure out a way out of this, I'm done, versus risk capacity. What can you absorb financially? We tend to see a large disparity between entrepreneurs and their significant others in both of these categories. So entrepreneurs typically have a much higher risk tolerance than their significant other, and they have a higher risk capacity. They understand what their total balance sheet looks like, where they can afford to take larger risks, and where they can't. Spouses tend to feel like we've got all our eggs in one basket with this business. We've already got plenty of risk that's riding on the primary business that we're engaged in. Let's keep the rest of this really, really low risk. Neither of those perspectives are incorrect, but reviewing that distinction between tolerance and capacity for risk can really help bridge the gap. And usually it's a good idea that when money comes out of the business, you do have some that is lower risk. You do have some that is higher liquidity to back up that illiquid, high risk, high reward business investment that you're making. So as you've done all of this, wrap all this up into an investment policy document. So you're going to give all of those dollars, all of those accounts, names, purposes. You're going to talk about how you'll invest each of them individually, what your expectations are, and what would need to change in your life or in the market in general for you to change your plan. And that can be for any piece of those, right? So you may say premium money market is a great deal today at 5.25. That's essentially free money with very, very, very low risk. I'm going to go ahead and take advantage of that in a much broader way than you would have, 4 or 5 years ago when you were generating less than 1% on those same assets. So think about what's going to need to happen in the environment for you to change your mind. Now, so we've gone all the way through. We've talked about why we invest. We've talked about financial planning. We've talked about how to give our dollars a name and a purpose, how to segment and look at what each of our accounts need to be doing. And now we're finally going to look at asset allocation. So here are some of the major categories that we look at: cash, cash alternatives, liquid public markets, meaning stocks and bonds, which are liquid and publicly available and traded, liquid alternatives. This has really been a growth area. More access to private credit, private equity inside the wrapper of exchange traded funds or interval funds or mutual funds in ways that you previously would have had to invest directly and have those funds be highly illiquid. A lot of them now give you quarterly windows to gain access to your capital. So quarterly liquidity provisions are certainly something that is there in a way that it didn't used to be. It's made those a lot more attractive. Also, when we're thinking about some of those other options in terms of liquid alts, Bitcoin and gold are both inside ETFs. Gold has been there for quite a while. There are ETFs that track gold miners, the price of gold itself, essentially vehicles that allow you to redeem your virtual holdings for physical gold on delivery when you would want them. And the Bitcoin ETFs. There may be other cryptocurrency ETFs by the time you listen to this recording. That space moves fast, but certainly Bitcoin has a lot more access to liquidity. And now looking at non-liquid alternatives, we have real estate as a big one. So you have direct deals, syndications, qualified opportunity zone funds, DSTs to execute 1031 exchanges. Those are all different ways to utilize real estate that a lot of our clients do use in various combinations at various points in time. Venture capital is going to be another one where typically your capital is locked up at the long end of the spectrum, so like 7 to 10 years until you're expecting to see a return. Very high failure rate. The payoff on the big winners is exponential, so that's why a lot of people play there if they're going to play there. But for most of our clients, you really have a venture capital bet, or at least a private equity bet, which has been placed on your business equity, so you don't need to weight those as heavily as some other investors who don't have access to that type of exposure. So hopefully this was a good overview thinking about investment planning, what comes first, focus on what you're trying to do, and then how to actually put the process together. If you want to work with our team to do this, this is what we love to do all day, every day, along with tax planning, financial strategy, business strategy, all of those different pieces. So if we can help you, head over to entrepreneuraligned.com, and I would love any questions or comments that you have so that we can make this podcast even better than it is. Thanks so much for giving me some of your time. Be back with you again soon.